is November 2024. It's a question 1. But then option pricing was the B part. So I took off the A part. The A part was business valuation. I took off the A part because that's not my focus. My focus is on option pricing for this this practice. So this is November 2024 question 1. So if you want to see the full question, please you can go to November 2024 question 1. But I'm just focusing on the option pricing part. So I took off the other part, which was on investment, business investment appraisal. Okay. All right. So I guess by the blank page in between the two. But let's read the question. And then this is the requirement of the question, which is explain the circumstances in which the Black-Scholes option pricing model could be used to access the value of a company, including the data required for the various. So you can go back and I'll let you guys go and read this up from the pack. It's November 2024 pack. So I'll let you guys read that. So I'm going to focus on this part, which is using the Black-Scholes option pricing model, estimate the maximum price and premium pay Tolade may pay for a year. So that's our focus. The maximum price and the premium. So that's our focus. So why is it an option? Why is option pricing important? Is because whenever you look at the company acquiring another company, the company has the right, but not the obligation to do it. Now, whenever you have a question on option pricing model or option pricing theory, rather, the first thing you would always do, which is the most important thing, is to identify the 5 elements of an option pricing model. Five elements of the option pricing model. And what are these 5 elements? They are SO, which is the current market price of the underlying item. So take, for example, that you have an option to buy a plot of land for 5 million in 3 years' time. SO would be what is the current price of that land. That is SO, the current market price of the underlying item. E would be the exercise price by the option. In other words, what do you need to give up now to be able to have control of that underlying item or the asset? So assuming that, let me use the example I just used a few seconds ago. You have an option to buy a piece of land at 3 million in 3 years' time. What is the current price of that land? So assuming the current price of that land is 5 million. So SO will be 5 million, which is the current price of the land. But you have an option to buy it at 3 million in 3 years' time. So the exercise price would then be 3 million. The other elements are going to be very easy to determine. R is the risk-free rate. So the question would always tell you what the risk-free rate is or how to determine the risk-free rate. T is the time to maturity in years. So a formula by the Black-Scholes option pricing theory requires that we have the time to maturity in years. So what that basically means is that if instead of giving you the number of years, they give you the number of months, The time to maturity in years would just be the number of months divided by 12. That would give you the time to maturity in years. And then finally, you determine the standard deviation. So that's the first thing you would always establish in any question that is, that is an option pricing question using the Black-Scholes option pricing model. That's the first thing we'll determine. The next thing we'll determine would be to determine the type of option. To determine the type of option. And there are two types of options. It could be a call option, which is the right to buy something, or it could be a put option, which is the right to sell something. So if the option you have in front of you evaluating is the right to buy something, that would be a call option. And if it is the right to sell something, that would be a put option. And if it's a call option, this is the formula. And if it's a put option, this is the formula. So look at what the formula is for the call option. Formula for the call option is our current market price, the current price of the underlying item, multiplied by ND1. N is natural log of D1, minus the current exercise price, which is E, multiplied by ND2 multiplied by exponential constant raised to the power of minus RT. So if it's a call option, this is the formula you would use. Now, if it's a put option, is equals to C. So what does that mean? It means that whenever you have a put option, you must first find the value of the call option. Did you see that? That's why we're having that C first. So whenever you have a put option, which is the right to sell something, you must first calculate what the C is, which is the value of the call option. So that minus SO, which is the current market price of the item, plus E multiplied by the exponential constant raised to the power of minus RT. All right, guys, so that's what you need to take note of. So this is the value of the call option and the value of the put option. Call option is the right to buy something. A call option is the right to buy something. A put option is the right to sell something. Now, this element is what you really need to know, especially the SO and the SE. For some type of transaction, it's very easy to identify what the SO and the SE would be. For example, if you have the right to buy something, it's easy to know what is the current price of that item, what is the exercise price. But for some other type of options, it is not that easy to identify. So you need to know ahead of time what the SO is and what the E is for those items. And an example of that is when you are evaluating an option to merge or demerge. When you are considering the option to merge or demerge, and you're trying to establish what the value of the business is, which is the value of equity. That is the focus of our question. So whenever you're trying to value the value of equity, your SO, which is the current market price, would basically be your total assets less current liabilities at the beginning of the year. At the beginning of the year. And your E would be the market value of the debt. And the reason is because if you own a business and you have debtors or long-term liabilities, as a businessman, there are two things you can do, and that's where the concept of option comes out of it. If you feel that you want to take a full control of your business, what are you going to do? You're just going to pay those you are owing, which is the excise price. You're going to pay those you are owing. Once you pay your debtors at the amount you owe them, it gives you full control over your business because nobody's laying claim to any of your asset. All of your debtors have been settled. And that is why the market value of the debt is rightly called the exercise price, because that is the amount you need to pay to have a full control over your asset. And so when it comes to the value of equity, our SO is the asset value less current liability. For you to gain control over that, you need to pay off your debtors. That makes it the call option. So let's go to our question and apply this principle to that. We need to, our SO is the current value of the current price of the item or what we're evaluating. So right now we're looking at the value of equity. That is our SO. Our E would be what you need to pay to be able to have full control over that item, and we need to pay off our debtors. So let's go right to our question, and then we'll apply the principles in there. So let's go to our question. All right, so here is our question. It says, so it's November 2024, in case you want to have a look at that. It says, Tolade Plc is a listed company which operates in the pharmaceutical sector, manufacturing a broad range of drugs under license in a number of countries around Africa. In recent years, the company has grown organically, but a proposal has now been put forward to the company's investment bank that the company might consider the acquisition of Iyadun Plc, bracket Iya, as a route to both further expansion and diversification of the company's activities. Iya is involved in a different area of pharmaceutical sector from Tola, as it is primarily a research-driven company involved in the development of new drugs arising from the latest academic research, often working with research departments of universities to turn research into commercial reality. The two companies have been trading for over 15 years and have grown and have shown strong levels of probability in most recent years. Tola is financed wholly by equity. That's the original company. Whereas, sorry, where is that? Okay, so whereas Tola is fully listed on the main market, Iya is listed on the alternative investment market. However, both company shares are thinly traded. It is generally believed that the market value of equity of Iya represents 75% of its true market value. But it is felt that Tola shares are not quoted accurately by the market. The following information is taken from the financial statement of both companies at the start of the year. So this is what you have at the start of the year. So this is what you have. The current yield rate is 5% and the current equity risk premium is 6%. It can be assumed that the risk-free rate of return is equivalent to the yield rate. Tola's asset beta has been estimated to be 1.26. Tola wants to use the Black-Scholes Option Pricing model to assess the value of the combined business and the maximum premium payable to IA's shareholders. So it wants to use BSOP to do two things. One is to determine the value of the combined business. That's the first thing. And the second thing is to determine the maximum premium payable to IA's shareholders. Tolade has conducted a review of the volatility of the operating profit of both companies since both were formed, and has estimated that the volatility of the combined business assets, if the acquisition were to go ahead, would be 35%. The exercise price should be calculated as the present value of a discount zero coupon bond with an identical yield and term to maturity of the current bond. Both companies pay tax at 20%. Okay, so I think I missed out something when I was copying this out. So these are the values, cash flow values at the end of the year. So I could just put that here. I missed that out. So these are cash flow values at the end of the year. So we have our depreciation, profit on disposal of non-current assets, and all of that. Then we don't have a requirement. Yeah, discuss the B part we're focusing on. Using the Black-Scholes Option Pricing model method, estimate the maximum price and premium Tolade may pay for IA PLC. All right, so there we have it. So let's quickly recap the gist of the question. So you have Tolade as a company trying to acquire IA PLC. And they're trying to establish what is the value of the two firms? What is the value of the combined business? So if IA and Tolade were to merge, what is the value of the combined business? And based on that value, if the Tolade needs to pay for IA's PLC, what is the maximum premium it needs to pay? So those are things we need to consider. And it is an option because Tolade can decide to merge with IA or can decide not to merge. And that's why it's an option. That's why we need to use the Black-Scholes Option Pricing model. So let's go back to our option pricing model and begin to look at our steps. The first thing is we need to identify the 5 elements. And the 5 elements would be: 1, what is the current market price of the underlying item? In other words, we're beginning with the combined company first. So we're beginning with the combined company first, which is our first part. We're looking at the combined company, which is our first part. And the combined company is made up of Tolade plus IA. Yeah, so our SO would be: what is the current market price of the underlying item? And the underlying item would be the two companies, IA and Tolade. The company is owned by the shareholders. It is not owned by those that own the company. It is owned by the shareholders. So what is the value of the company to the shareholders or to the owners of the business? That would be our total asset less current liability. That's our SO. Asset less liability at the beginning of the year. At the beginning of the year. So can we go back to the information we have? So don't get distracted by any other details in the question. Just focus solely on the information we need. And the first information we need is the value of the underlying item, which is the value of the business to the owner. And that is our total asset less current liabilities at the beginning of the year. We're looking at the combined entity. So can we go back and pick just that information without any other thing, without being distracted by any other thing? So this is the following information is taken from the financial statement of both companies at the start of the current year, which is what we're interested in. So what is our asset less current liability for both companies at the start of the beginning of the current year? So we have assets right here. Where's that? Sorry, I've sort of lost my pen. It's not showing. Just a minute. Let me reconnect that. Okay, so it's there. So this is our assets less current liabilities. So that is 22,000 for this guy, 21,000 for this guy. So what do we have as our SO? 22 plus 21. So that is 22 plus 21. So that gives us a total of 43,000. The next element we need to determine is E, which is the exercise price. So what do we need to give up to have full control of our business? What do we need to give up to have full control of our business? If you're a businessman, you have a business and you have people that owe you, those guys that owe you have claim over your business except you pay them off. So that's what you need to give up. That's our exercise price. So we need to give up by paying our debt. And based on our definition, we're concerned about not the book value of the debt, but the market value of the debt. That's what we're interested in. What is the market value of our debt? So let's look at let's go back to our question and see what the market value of our debt will be. Let's begin with what we have in the balance sheet first, and then we'll then see if there's any information that helps us calculate the market value. So this is our debt. So this is our debt right here. Okay, where's our debt? Okay, yeah, this is our debt here. So 5 years floating rate loan at yield rate plus 3% gives us 15%. Okay, so the 5-year floating rate loan at yield plus 3% gives us a total of 15,000. So 15,000 is our 5-year floating rate loan at yield rate plus 3%. So that's a total of 15,000. So the book value of our loan is at 15,000. And the 5-year floating rate loan. And that is the book value. But what we're interested in is our market value. So this is our book value. What we're interested in is our market value or present, sometimes we can call it present value of that amount, present value of the loan. How much is it worth rather? All right, so it's 15,000. Now this is a 5-year floating loan. So we need to determine what is it worth. What is it worth in 5 years' time? We'd always discount. It's a 5-year bond. So in 5 years' time, what is that 15,000 worth? In 5 years' time, what is the 15,000 worth, which is the present value? Pretty straightforward. All we need to do is to multiply that value by the discount factor. So all we just need to do to get the present market value of the loan will just be our book value multiplied by the discount factor. So the book value of the loan is 15,000. Pretty straightforward. What's our discount factor? Our discount factor formula is 1 plus the rate of return raised to the power of minus n. Which is n. N is the number of years. So how many years is this bond? The bond is 5 years. So that is pretty straightforward. Sorry, I've passed that. Our N is the number of years. So it is a 5-year floating bond. So our N is 5. So that one is pretty straightforward. It's 5. What is our R, which is our rate of return? Let's go back to a question on the bond and see what our R is. It says that the 5-year floating rate loan is at yield plus 3%. So what is our yield? Right here, it tells us that the current yield rate is 5%. So that would be 5 plus 3 gives us 8%. So can we calculate our discount factor? Now that we have R and we have N. So that would be the yield of 5 plus 3, which is 8%. So our discount factor will basically be 1 plus R, 0.08 raised to the power of minus 5. Okay, so what do we have as that? It's my calculator. Okay, so that's 1.08 raised to the power of minus 5. So that is 0.681. So I can just multiply directly, multiplied by 15,000, which is 10,208. 209, just to think of the decimal places. So that gives us the current market present value of the debt. All right, guys. So we already have our SO and our E. The other ones are pretty straightforward, and they are the risk-free rate, the time to maturity, and the standard deviation. We can always pick those ones pretty straightforward from our question. So let's go back to our question quickly and pick those ones up. So our risk-free rate from the question is given to us pretty straightforward here. Yeah. Okay. Okay, so let's look at that. I think it's somewhere here, okay. So we have the current yield rate is 5%. The current risk premium is 6%. It can be assumed that the risk-free rate of return is equivalent to the yield rate. And the current yield rate is 5%. So you can assume that the risk-free rate is equivalent to the yield rate. So a risk-free rate is 5%. So we can put that down as 5%. So that's 5%, which is 0.05. Our time to maturity, how long do we have to pay the loan? How long do we have to pay the loan to get good ownership? Our loan is a 5-year floating rate loan. So we have to pay it within 5 years. So that's 5. So that is 5. Then our standard deviation. So where's our standard deviation? Somewhere here, which is the volatility. Right here, it says Tolade has conducted a review of the volatility, which is our standard deviation. So our volatility is our standard deviation of the operating profit of both companies since both were formed, and has estimated that the volatility of the combined business assets, if the acquisition were to go ahead, would be 35%, which is 0.035. So standard deviation would be 0.035. Okay, guys. Any question on these 5 elements? Because when it comes to Black-Scholes option pricing model, identifying the 5 elements is actually the most important part of every solution. All right, so I will just do a quick recap on that before we proceed. The SO is our total assets less our current liabilities at the beginning of the year. So we look at what our total asset less current liabilities for company A, for company B, because we're looking at the combined entity. So it's 22 for Tola and 21 for year. So that gives us 43,000. Our E is our present value of the debt. The present value of the debt. So that would be, we need to discount whatever the value we have in the books of account to reflect the present value. And we know that to discount, we just multiply the book value by the discount factor. And so our discount factor formula is 1 plus R is power minus N. R is the rate of return. The question tells us that the rate of return is equal to the current yield plus 3%, and the current yield is 5. So 5 plus 3 gives us 8%. And that gives us this. Every other thing is pretty straightforward to identify. The next thing is to determine the type of option.
Sorry, sir.
Okay, please go ahead.
Hello, sir.
Yes, please go ahead.
Yeah, our standard deviation is 35%. I think it should be 0.35, not 0.035.
Okay, let me have another look at that. 35%. What did I write? Is 0. Oh, yeah, 0.35. Thank you for that. Yeah. So that's 0.35. Okay, thank you. So that is 0.35. Very true, very true. All right. So that's the first thing we'll establish from our question. The next thing we'll then establish would be what type of option are we looking at? Because the type of option we're looking at will determine whether we're using the formula for a call option or using the formula for a put option. A call option is the right to buy something. A put option is the right to sell something. So what does Tola want to do? Does Tola wants to buy IYA PLC or wants to sell IYA PLC? All right, so let's go back to our question. So we can clearly see here that Tola is considering investing or buying the company. Says that the company might consider the acquisition of Iyadun, the acquisition or the purchase of Iyadun. So because what is considering is acquisition, it becomes a call option. It becomes a call option. Yeah, so we know it's a call option. If we are to sell, we know that it's a put option. Because it's buying, we know that it's a call option. So the option type is a call option. So let's quickly recap by writing out our formula for a call option. So that's our formula for a call option right up there. So I'm just going to copy it down. So that is SO ND1 minus E ND2 multiplied by exponential constant raised to the power of minus RT. Our SO and our E, that we already have them here. So this is our SO and this is our E. So those ones are pretty straightforward there. We don't have our ND1 and our ND2. So these are the steps we will take. One, we'll calculate our D1. Two, we'll calculate our D2. Three, we'll calculate our ND1. Four, we'll calculate our ND2. Five, we calculate our exponential constant. And then six, we then put everything into the formula. So we'll put together all the calculations. Into formula. So these are the steps we would take to be able to get all the elements we need for our calculation. please. So if you follow these steps, guys, you would never get it wrong. You follow these steps, you would never get it wrong. So you just need to follow these steps to get it right. So let's begin with our calculation for D1. And there's a formula for calculating D1. So this is a formula for calculating D1. It is our natural log NE bracket our SO divided by E plus our risk-free rate, whatever it is, plus 0.5 multiplied by our standard deviation squared. We multiply that by T divided by our standard deviation multiplied by the square root of T. So we're going to put all of those into our formula and get it out. Our D2 is much easier. It is our D1, whatever we calculate here, minus the standard deviation multiplied by the square root of T. In other words, what you have here minus what you have here, and that gives us our D2. We're going to come back to our ND1 and ND2 later on. Let's do our D1 first and our D2. So let's begin with our D1. All right, so our formula for our D1 is our IN, which is called natural log. So let's just write IN. We're going to come back with that from our calculator. Bracket our SO divided by E. So what is our SO? Our SO is 43,000. Our E is 10,209. So 43,000 divided by 10,209. So 43,000 divided by 10,209 plus our R, which is our risk-free rate. So what do we have as R in our question? 0.05. So that's our R. 0.05. Okay. Multiplied, sorry, our R plus, rather not multiply, plus 0.5, which is a constant value, plus 0.5 multiplied by our standard deviation squared, square root of our standard deviation. So what is our standard deviation, which is this? 0.35 square root of a square of 0.35, rather not square root, 0.35 square of that. 0.35 squared multiplied by T. This is T. And what is our T? 5. Our T is 5. All over our standard deviation, which is 0.35 right here. Multiply by the square root of T, which is 5. Okay, so let's get that. Let's get us out together then. So let's begin with the first one, which is our natural log of 43,000 divided by 10,209. So if you haven't done it before, well, I want to believe you guys have, since we're just doing question practice. But if you haven't, we can just do it together right away. So in your calculator, to the far right, the column to the far right, you're going to have the 1, 2, 3. So the third button down, you're going to find the LN or IN, depending on what is written in your calculator. So you might have IN, you might have LN. So just press that value down. When you press it, you're going to have LN showing on the face of your calculator. You can then type in 43,000 divided by 10,209. You then close the bracket. So that gives you 1.438. Guys, hope you have you using your calculator. Hope you have that same value. Hope you have that same value. If you don't have the value, please let us know so we can guide you through it. So the natural log button is to the right, the last column in your calculator. So the third button down there. You're gonna have LN or IN, depending on how it's written on your calculator. Just press that value and then type in for 3,000 divided by 10,209. All right, so if you've gotten that right, let's look at the next part. Now, this part will require that you apply the principle of BODMAS or PATMAS, depending on what you use for your calculation. So this is how you're going to do. We're focusing with the inner bracket. So we're going to begin by solving this first, which is 0.35 raised to the power of 2. Whatever we get, we will multiply it by 0.5. That's our second step. Whatever you get, you add 0.05. And then everything you've gotten up to this point, you then multiply it by 5. You need to follow this step, otherwise you get it wrong. So we're going to start with the inner bracket, 0.35 squared. So what do I have on that? Just a minute. So 0.3, oh, sorry, what's wrong with my calculator? Just a sec. Okay, so that is 0.35 squared. I have 0.1225. That's our first step. Multiply that by 0.5. I have 0.06125 plus 0.05. I have 0.11125. That's step 3. Then multiply everything you have there by 5. So I have 0.556. 0.556. So divided by the square root of 5, the square root of 5, whatever the answer is, multiply it by 0.35. I have 0.783. Okay, what's that D1? 1.438 plus 0.556 divided by 0.783. So you have 2.547. Any question on D1? Any question on D1, guys? All right, so let's move a little bit forward then. So we have calculated our D1, which is this first step. Our D2 would be our D1. Okay, someone's hand is up. Okay, I'll attend to that now. Okay, Juliet, go ahead. Go ahead before I proceed. Go ahead, Juliet.
Good evening, sir. Please, I'm not
Yeah,
getting the figure you got in the D1. That's the 0.556.
Okay, so you're going to, because it's made up of a bracket and an exponential and everything, you need to follow the BODMAS principle. So let's do it together. You're going to begin with this, the exponential inside the bracket. So 0.35 squared, what do you have? Can we do it together? 0.35 squared, what do you have?
0.1225.
Perfect. Multiplied by 0.5, which is the next step. What do you have?
0.06125.
Sorry, let me do that with you so that we don't go back again. So 0.35 squared multiplied by 0.5. Yeah, 0.06125. Right?
Yes, sir. Yes, sir.
Okay, so yeah, so then add 0.5. What do you have? 0.05 rather. What do you have?
0.11125.
Great, then multiply that by 5. Which is this one outside, this 5 outside.
Okay, yes, I've gotten it. I was multiplying like through by 5 before adding the 0.05.
No, because this 5 applies to everything here. So you need to add the 0.05 first before you multiply this. So that's why you need to follow these steps. Otherwise, you're going to miss it out.
Okay, sir. Thank you very much, sir.
You're welcome. You're welcome. All right, guys.
Hello.
So
Hello,
we
sir.
yes, please. Yes, please. Yes, please.
Thank you for doing this for us. Thank you, sir.
You're welcome. You're welcome, sir. You're welcome. All right. So we've calculated our D1. So the next thing will be to calculate our D2. And the formula is very easy. Our D1 minus the standard deviation multiplied by the square root of t, which is what we have here. So it's going to be pretty straightforward. So our D1 is our D1 is 2.547 minus the standard deviation multiplied by the square root of t. We calculated it before, which is what we have on the denominator, 0.783. So we just copy that down, 0.783. So what do we have? So 2.547 minus 0.783. So 1.764. Okay, so that one should be pretty straightforward, which is our D1. And our ND1 and ND2, which we're going to calculate next. Now pay attention to this. Now, the normal distribution table we have in our ICAN pack is a one-leg normal distribution table. So we need to make some adjustment to it. So what adjustment do we make to it? If our D1 is a positive value, we do 0.5 plus whatever we read from a natural distribution table. But if it is a negative value, we do 0.5 minus whatever we have in our normal distribution table. The same thing with our ND2. If our D2 is positive, we do 0.5 plus whatever we have in a normal distribution table. And if it is negative, we do 0.5 minus. So please take note of that. If D1 is positive, we add 0.5. If it's negative, we take off 0.5. So let's look at our calculation and see what we have for each of them. If it's positive, we add 0.5. If they're negative, we take off 0.5. So our ND1, is D1 positive? Yes, it is positive. So 0.5 plus whatever we read from our normal distribution table. Our D2 is positive as well. So it will be ND2 0.5 plus. If it's negative, we take off negative. So we're going to go and make use of our normal distribution table right now to read these values. Now, there are two methods that I can recommend for the reading. I like the simpler method. Now, because for students, really, the simpler method is easier. Now, one of the methods would be that we make adjustment for every single digit we have here. The second method would be that we round this up to 2 decimal places and read just the 2 decimal places from our table, and which is the approach I like. So let's round it up to just to two decimal places then. So 2 decimal places would be 2.55. 2 decimal places would be 1.76. We then read these values from our normal distribution table, or you can take the other approach to read everything from the normal distribution table, which will require more adjustments. But let's do the either one, which is round it up to 2 decimal places. So with that rounded up, guys, let's go to our normal distribution table. So we're going to read 2.55 and 1.76 from our normal distribution table. So I'm going to open a pack that has a past question. I think the one I opened the last time should still be open. It should still be open. Just a sec. Let me share that question I opened the last time on November 2024. I'll just go to our normal distribution table. Yeah. So this is oh no, this is our annuity table. Okay, so this is our normal distribution table. Can you guys please see our normal distribution table? Can you see that at the end?
Yes, sir.
All right. So now the reason why I rounded it up to 2 decimal places is because if you look at this up, if I don't want to make adjustment, you look at this up, it's just that 2 decimal places. So you can see there are 2 decimal places. So it's easy for me to read it if I round up to 2 decimal places. If I don't round up, I need to make adjustment for the entire value, which is not worth the entire stress. So our D1 is 2.55. So can we read 2.55 from this table? We're still going to start from here, from our Z table. So we're going to go down to where we have 2.5. Can you guys see 2.5 here? 2.5. So once you find the first value, we move to the right. So this is 2.50. This is 2.51. This is 2.52. This is 2.53. This is 2.54. And this is 2.55. So what's the value of 2.55? 0.4946.
0.4946.
0.4946. So we're going to pick that value 0.4946. We're going to pick that value 0.4946. So you can just note it down somewhere. And let's look at the second one, which is 1.76. So this is 1.41. This is 1.7. So let's find 6. This is 1.70. This is 1.71. This is 1.7, 3, 4, 5, 6. What do you have under 1. What do you have under 1.76? 0.4608. Can you guys say it? Or you want me to show that again? Can you guys say it? 1.76, 0.4608. Any question on how we read this table before we leave this table? Okay, so I want to believe that we're all good with the reading. So we just think of the value. 2.55 was 2.55 was 0.4946. So we're going to go with that. And 1.76 was 0.4608. Okay, so let me see if there's any hand before I leave here, because I've just noticed this value. I'm going to copy these values along with me. Jeremy, please go ahead.
So my question is about how to read this table.
Okay, so that's what we just did now. So I'm going to take it one more time. Do you know what the values we have on that D1 is? Can you see the value we got on that D1? Before we move to this part. 2 point what?
2.55.
2.55. Yeah, so let's look at the table. We're going to start from here. So can you find 2.5? Can you see 2.5 here? Can you see it?
Yes, I can see it, sir.
Okay, so we're looking for 2.55. So we're going to now move. So this is 2.5. So we're going to move now to this side now. This first one here is 2.50. The next one after that is 2.51. See the one on top here. The one after that is 2.52. The one after that is 2.53. So 2.55 would be this one, 2.55, 0.4946. Can you see that?
Yes, I can see it. Thank you very much, sir.
All right. So let's go right back to our solution. So I've copied those values. So let's go right back to our solution. Okay, so the next one is 0.4946. And the other one is 0.4608. Okay, so what's our ND1 and our ND2? So it should be 0.995. Just keep it to 3 decimal places if that's what we wanted to do. The next one would be 0.9 0.961 rather, 0.961 rather. This is 0.8, so I'm just keeping the 3 decimal places. So 0.931, this is 0.961. All right. So those are our ND1 and our ND2. So I'm keeping the 3 decimal places because my original answers here, I kept them to 3 decimal places. So I only just wanted, so I'm keeping them to 3 decimal places. But if you wanted to keep everything to 4, just be consistent with it. That's what ICAN would typically require, that you be consistent with your decimal places. So these were 3 decimal places. That's why I'm keeping my answers to 3 here. Okay. So that's our ND1 and our ND2. The next thing we'll calculate would be our, which is our step 5, our exponential constant raised to the power of RT. So that's pretty straightforward. E is the power of minus RT. We don't know what E is, so let's keep what it is. What is our R and what is our T? Our R is our risk-free rate, which we already which is 0.05. Our T is 5. So that is minus 0.05 multiplied by 5. Okay, so what do we have? 0.05 multiplied by 5. What does it give us? Let's make it. That's 0.05 multiplied by 5, 0.25. So that is E raised to the power of minus 0.25. Okay, guys. Now go back to your calculator. That very button where you have ln, on the body of the calculator, you would see E written on it. Now to activate that E, just press down your shift button. Press down your shift button and then press that button where you have ln that you used before. If you press that, instead of it showing ln, it will show E. Then impute minus 0.25. So that is 0.779. I'm keeping all my answers to 3 decimal places because that's what I'm using. Does anyone have a different answer? We need help with that. Okay, so if we're all good, let's put all of our values together.
Sir, can you take it back? No, sir. Can you take it back, sir? I miss it.
Okay, so that button that you used, the button on your calculator that you use when you were pressing the natural log, this ln, can you see the button? Can you see it? It's to the far right of your calculator, the last column, the 3rd button there, you're still going to see ln. Can you see it? Can you see it, sir? Okay, so maybe I lost you. So if you see that button, you would see on the body of the calculator E raised to the power of X. That is exponential constant. So to activate that button, you just have to press down the shift value of your calculator, then you press that ln. So once you press shift and press that ln, it shows E, which is exponential constant raised to the power of X. So just write in minus 0.25, and you would have 0.7788. But because I'm running to 3 decimal places, I'm doing 0.779. All right. So let's now calculate our value now quickly. So now that we have everything, so we can, this is the longer part. The last part won't take us more than 5 minutes to finish. So let's now put everything to our formula. Now that we have calculated all of the elements. So what is our formula now? Our formula is okay, please let me mute yourself if you're not speaking to us. Okay, so let's put everything together into our formula. Our formula is SO. Sorry. Okay, so our formula is SO, which we found we determined before now. Pretty easy. SO is 43,000. So 43,000 multiplied by ND1. What is our ND1? We just calculated that not too long ago. ND1. 0.995. 0.995 plus E, which we determine as 10209. 10209 multiplied by ND2. We just calculated ND2, not too far. ND2, yeah, this is ND2, 0.961. Multiplied by E raised to the power of RT. So we just calculated E raised to the power of RT, which is 0.779. 0.779. Okay. So let's calculate the value of the combined company quickly then. Okay, so the first part is 43,000 multiplied by 0.995 multiplied by 0.995. So that is 42,785. 42,785. Oh, sorry, formula is minus, not a plus. So I had to go. I said formula is minus, not a plus. So I just needed to double check that. Just to be sure I didn't write the wrong formula up for changing this, okay? So this minus, not a plus, please. Okay, so the other line will be 10209 multiplied by 0.961 multiplied by 0.779. Minus 7,643. Okay, so what's the value of the firm? 42,785 minus 7,643. So that gives us 35,142 as the value of the combined firm. Any question, guys, on the value of the combined firm? Value of the combined firm is 35,142. So if you combine both Tola and Iya, the value is 35,142. But Tola is trying to determine two things. Tola is trying to determine two things. One of the things Tola is trying to determine is if I want to procure Iya, how much, what value do we need to pay? How much do we need to pay for Iya? The value of both companies is 35,142. So how much does Tola needs to pay for Iya? First, let's even determine what extra value does Tola get from acquiring Iya? What extra value would Tola get from the acquisition? So let's determine what the extra value is. So extra value from the acquisition. If combined, we're looking at 35,142. Without combination, bracket, Tola only, what would be their total assets less current liability without combination? So 35,142 is the value if they are combined. Now, without combination, what will be the total value? What will be the value of Tola, so that we know what the difference is, so that when they are going out to price Iya, they can have an idea of what value is Iya bringing to the table, and then they'll then determine how much are they willing to pay for Iya. So let's look at what happens before the acquisition, without the acquisition. And without the acquisition, Tolada's assets less liability is 22,000. However, we will not forget something. They plan in the course of the year to issue additional shares of 2,000. So 22,000. If they issue the additional shares of 2,000, they will have a total value in their books of account of 24,000. So without the combination, they're looking at 24,000. With the combination, it was it's 35,142. So without the combination, looking at 24,000. So what is the increase? So let's do that calculator. 35,000 minus 24,000. So 35,142 minus 24,000. So that's 11,142. Increase. So what that basically suggests, what that basically shows is that the increase is 11,142. So if they are going to buy IYA, they cannot pay more than 11,142 because that is the amount that the IYA is bringing into the combined entity. Without IYA, Tolade is worth 24,000. With IYA, it is worth 35,142. That therefore means that if they are to buy IYA, they cannot spend more than the increase that the IYA is bringing into the new business. So we can say that the above shows that the maximum amount Tolade can pay should not be greater than the increase in value. Greater than the expected increase in value. Which is 11,142. Any question on that? Any question on that first part? And then that's the first part. That's the maximum Tolade would pay. Because if the two companies is worth 35 and Tolade alone is worth 24, the difference is the increase. So if you're going to pay for any guy, anybody, anywhere, you should not pay more than 11,142. Then the next part of our question, which is going to be pretty fast, would be the premium, which is if you're a shareholder of IYA, what do you expect above the current value of IYA? And that is the maximum premium payable. So that's the other part of the question. It's going to be pretty straightforward as well. Premium payable, which is the maximum value over the current value of IYA. We know that Tolade cannot pay more than 11,142. So when we subtract the current value of IYA, you tell us the maximum extra we can pay. Which is the premium. So if, for example, the value of IYA is 10,000, it means that we cannot pay more than 1,142 extra to that 10,000, which is their value. If the value is 8,000, we cannot pay more than, because for us at Tolade, the total amount we can pay will never be more than 11,142. But for the shareholders of IYA, they're interested in what extra can we get out of this deal. So let's see what it would be. It would be 11,142, which is the maximum we can pay minus the value of IYA. So can we quickly calculate how much IYA is worth, which is basically the same thing. Let's look at how much IYA is worth quickly. So let's go right back to our question and see how much is IYA what in the market. And then we can then do that subtraction and we can then finalize. Oops, sorry, I think I've passed that. Okay, so to the owners of the business, to the owners of Tola, the business is worth 22,000. They have the entire business because they don't have any debt. They don't have any loan. So the 22,000 plus the extra 2,000 gives us 24,000. They don't have any loan. IYA's total asset less liability is 21,000. However, out of the 21,000, they have a loan of 15,000, which is this 15,000, meaning that the shareholders have only 6,000. You cannot give the shareholders what belongs to those you are owing. Out of the total value of 21,000 for IYA, out of the total value of 21,000, you are owing 15,000. So you only have 6,000 left. You have 6,000 left to represent what the equity holders do own. And that is the value of IYA. However, the question provides some additional context that helps us identify what the market value of IYA would be. So we'll just do that quickly and then we can then close out. It's here, right here. It says, it is generally believed that the current book value of equity of IYA, which is the 6,000, represents 75% of its true market value. So this 6,000 as it is not its true value, but it represents 75% of its true value. So what then is its true value? If 6,000 is 75%, so what is 100%? That is pretty straightforward. That is basically 6,000 divided by 0.75. So that is 6,000 divided by 0.75. That gives us 11,142 minus, so what is the value of IYA at this point? 6,000 divided by 0.75. All right, so that is 8,000. So IYA is worth 8,000. But because Tola cannot pay more than 11,142, if it needs to add anything to that 8,000, it must not be more than an extra of 11,142 minus 8,000, which is 3,112. Maximum premium payable. So when they are negotiating with IYA, they'll just tell IYA, see, you guys are worth 8,000 based on your market value. When you join us, when you combine with Tola, you're going to just add an extra 11,142. So we cannot pay you extra above your current value by 11,112. Because if we pay you your current value of 8,000 plus anything above 3,112, which takes us to 11,142, that business combination will not make any sense to Tola because you are paying more than the target company is worth. Any question, guys? Any question, guys? All right. So if there are no question, I guess we've blown past 11, which is a good place to stop. So in the next couple of days, guys, I'm going to be shifting attention from calculation to more of theory. So in the WhatsApp group, I'm going to be dropping questions on theoretical part of the syllabus. So it helps you guys to think, maybe go back to your note and revise them, or look for us, or we can discuss the answer and all of that. So that in addition to your calculation, you also have some grip on the theoretical aspect of the syllabus, and that's what I'm going to be doing in the WhatsApp group going forward. All right, guys. Any question? All right. So if there are no questions, thank you so much, everyone, and we'll continue our discussion in the WhatsApp group. Thank you so much, guys. Have a good night, everyone.
I have a question.
All right, please go ahead. Please go ahead. Please go ahead. Go ahead if you do.
From my point of view, sir,
Okay.
option price model is also a form of business valuation.
So option can be used for not just business valuation, but any transaction where one of the parties has the right but not an obligation to undertake a transaction. So it's used in business valuation because when you are about acquiring a business, you can choose to go ahead or not go ahead. It could also be used for option pricing in currency risk management because it's an option. It's an option, so it can be used for that. It can also be used for option interest rate risk management. It can also be used for option in daily transactions where maybe a company has an option to establish an additional branch somewhere. And so they have to, so whether they do it or not, it's something that they have to decide. It's an option to them. So every single situation where you have the right but not an obligation to do something, option pricing can be applied. Okay, so regardless of the situation, the risk-free rate, the market, the risk-free rate, the standard deviation, and the time to maturity is going to be very easy to identify. So what you need to now look at would then be what is our SO and what is our E. And our SO would always be the current market price of the underlying item. In other words, for the transaction in the question, what is the key issue? In the one we just solved now, the key issue is a business acquiring another business. So we're trying to establish what is the value of the business. And the value can only be what is remaining to the owners after you have taken off what you owe those your debtors. Okay. So if, for example, you are using option for, say, share purchase now, for example, the current market price would be, the SO would be what is the current market price of that shares. E would be what is the price based on the option. If you're using option, for example, in currency risk management, the current market price would be what is the current price of the exchange? What is the current exchange rate? The option price would be based on the option. What would be the price based on the option? The RT and standard deviation will be pretty easy to identify in every single question. Is that clear, sir? So it's not just applied to, or it's not just applied to business valuation. It tells that this question was on business valuation.
Okay. Thank you. God bless you, sir.
Well done. So you guys, you can come around for past questions. If you have any challenge with any of them, please drop it to the group and we'll continue our discussion in the group.
Okay, sir.
All right. All right then. Thank you so much, everyone. We'll continue our discussion in the group. Thank you so much. Have a beautiful night, everyone. Thank you. Bye.
Thank you, sir. Good night, sir.
Yeah, good night. Bye.